Morning, everyone. Thanks for joining us today. I have just after 10 o'clock, so we're going to try to get started here to be mindful of your time today. Great list of people that have signed up and registered for today's conference, and a great lineup of topics, I think, today that are very timely for everyone working through the industry as we get going into the fall here. I have a thunderstorm that's scheduled to start here shortly, so hopefully electricity stays on this side. If it doesn't, my co-hosts, I'm sure I'll pick up the ball and keep things running as we go forward. So with that, I'm Heather Gessner. I'm the Extension Livestock Business Management Field Specialist based out of the Sioux Falls Regional Office, and I'll be your host today. With us today, we also have Matt Dearson. He is going to talk to us about LRP. And Jack Davis is going to talk about the current cash rental rates and land values and the new publication that has been released by SDSU Extension. So a couple housekeeping things. If you would like to ask questions today, please feel free to type them in. Click the little chat button at the bottom of your screen and type those in. They will come to me and I will get them asked for you. Otherwise, your other option is to unmute yourself and ask questions directly to the presenters as we go through the day or at the end of all the conversations. So with that, I will turn it over to Matt Dearson, and he can kick us off today with some changes to the LRP program.
Good morning, everybody. My name is Matt Dearson. I'm an Extension Risk and Business Management Specialist at South Dakota State University. We're going to take a look at Livestock Risk Protection, and it's kind of a funny program. It started its new fiscal year on July 1, and with that, they made some changes to the program. So we'll take a look at some of the changes and some of the details and put it in perspective for how livestock risk protection perhaps fits into your overall marketing and risk management plan. So let me share my slides here quick. We've got a full slide deck to take a look at, and then I'll ask for your input a couple of times during this as well. So hopefully now you can see a slide deck that says Livestock Risk Protection. Please, if you're not asking a question, please mute your microphones too. Thank you very much. So we'll start here. Nice picture of Harding Hall here in the background. Where I'm not located at this time because it's easier to broadcast some of the stuff from one's home office. Livestock risk protection, let's take a look. What is livestock risk protection? Livestock risk protection is insurance for livestock prices. The coverage has been available since 2003, 2004 for fed cattle, feeder cattle, swine, and it has been offered at times for lamb. It is price insurance from the date the insurance is purchased. It's very similar to buying put options. So most of the ag economics crowd is at least familiar with put options. If you are a producer with output price risk, so you're going to sell cattle in the future or sell hogs in the future, you have a risk of price going down. And a typical way to insure against negative price moves is to buy put options. This LRP, Livestock Risk Protection product, functions like that. And it says you're going to get coverage at 70, 80, 90 to 100% of an expected ending value. Coverage runs from 13 to 52 weeks, and this product is sold not by commodity brokers, but it's sold by insurance agents. So maybe you're working with a crop insurance agent and they say, we've got this livestock product as well. They're probably referring to livestock risk protection. Now I need Heather's assistance. If she would she put the first question out there for the participants. So I'm asking you to speak either on for yourself or for your clients, those you might work with, what your opinion is about livestock risk protection. If you've used it and it's worked well, select that. If you're completely indifferent to it, because we're economists or students of economics, you know, if you're indifferent between, well, you know, LRP, put option, I don't care, I'm indifferent. If you don't have any idea about it, put no opinion down. And if you've had problems with it, maybe select that last choice, that it's a frustrating product. Just trying to figure out where we are at.
About half of the participants have voted, so I'll give you a couple more seconds. See if we can find those last individuals. Okay, time's up.
Good. All right, so we can see that we've got a lot of people with no opinion, probably the crop farmers in the crowd. One indifference, I like that, and then a couple of people that say it works really well. So hopefully you've heard about the product in the past. We'll take a look at some of the changes and see if that might change your opinion of LRP going forward. So Heather, would you please stop sharing the results? Or maybe I can. Looks like I can, or not. I can do this. There we go. So what's changed with LRP and why might this matter to producers? A change that really started a year ago. Historically, the premium subsidy. So this is a federal crop insurance type product, so federal livestock insurance. Compared to crop insurance products, the livestock risk protection insurance premium subsidy had been very low. Before 2000, it was only 13%. A big change starting July 1 was an increase in the subsidy up to 25 to 35%. So that really tipped the scale and made it more cost effective relative to purchasing put options. So compared to the next best alternative, this now has, this tips the scale or makes it more viable going forward. And that increase in the subsidy does result in a substantial cost saving for producers looking at buying this kind of coverage. So that's a big take home message right off the bat. Big increase in the subsidy over time, and that should make the product LRP much more affordable than buying put options, all else equal. The products are nice. They settle to cash prices. This might reduce some of the basis risk that you'd have with cattle, especially calves, because it has a 10% price adjustment factor for beef steer calves. That's handy if you're a cow-calf operator looking to manage your price risk. And you can cover any number of head. Well, there's an upper limit, but it's nice to cover a small number of head. So normally, if you've been looking at buying put options on, say, this year's calf crop, you'd need 100 head to effectively use a put option contract. Here you could insure 30 head, 60 head, or your share of 75 head if you're co-owning these with a relative or the neighbor or something. It's designed for spot sales in the final 30 days of coverage, and the premiums, another change, the premiums are not payable until the end of coverage. So if you were to buy a put option, you'd have to pay the entire put option premium up front. With LRP now, you don't have to pay for the insurance until the end of the coverage period. So a huge change, and perhaps providing some financial flexibility with the product. Take a look at some of the additional details. How many head of cattle are insured? Well, if you think about the U.S. calf crop being about 1.6 million head in a given year, not a lot of producers insure their feeder cattle or calves with livestock risk protection. The high mark was in 2014. There were over 300,000 head insured, and last year, so between 2019 and 2020, they increased the premium subsidy somewhat, and that should have resulted in an increased demand for the product, and demand actually went down from 19 to 20, partly reflecting the market conditions as well. But it's not been the most popular product in the world, but in South Dakota, it has at times has been popular. Take a look at the breakdown for 2020. You can see that during 2020, so the fiscal year that ended June 30th of 2020, 19,000 head of cattle were insured in South Dakota. That did lead the nation in terms of its popularity on a per head covered basis. You can see the other states that where LRP on feeder cattle has been popular. It's the Great Plains. So you've got Kansas, Oklahoma, Nebraska, and Texas rounding out states where LRP on feeder cattle has been attractive. In South Dakota, just to put it in perspective, you can see that the number of head insured, we'll highlight this quick. The number of head insured has gone down since 2014, where over 80,000 head that year were insured. Last year, just under 20,000 head were insured. So South Dakota's calf crop, 1.6 million head, very few insured. The number of policies sold has gone down as well. So it's still not a very popular product, but again, I think that subsidy might come into play over time. The product is available on fed cattle as well. Here's the historic look at the LRP on fed cattle. So right now there's 12 million head of cattle on feed, and throughout calendar year 2020, there was under 10,000 head insured with LRP. The high point came back in the first full year of it being offered, where about 175,000 head were insured at that time. And after that initial experience, the product has not been utilized much on fed cattle. But still, in South Dakota, there are a number of producers who are able to make it work for them. How exactly does it work? A couple of highlights. If you are a cattle producer, you have output price risk. The futures price might change between now and when you sell your cattle. That may result in a higher or lower cash price. So in trade parlance or jargon, we say that you are long cash. You have a long cash position because you will be selling in the cash market down the road or in the future. So depending on what happens to the cash price, that will affect your returns. And usually we refer to producers having downside price risk. So what does that mean? That means that if the price falls relative to where it's at today, a producer is going to be worse off. So if they were expecting $100 or $200, 100 weight for a price, and the price falls, that's a negative event that would happen to a producer. So how does LRP function and work? LRP comes in and does a couple of things. First, you have a deductible, which lowers how much price coverage you have relative to the expected end price. Then you pay a premium. A premium is the difference between point B and point C here, the out-of-pocket expense for the product, but it results in a floor price that does its job over here. It stops the price from going lower or the losses from happening once the price falls below this floor price. And it leaves the upside open. So it protects against the bad things happening and lets you participate in good things happening. Guards against the price going lower, lets you benefit if the price goes substantially higher. What you're out the premium no matter what happens. So that's the basics of LRP, what it is and how it functions. I want to highlight real quick that the subsidy did increase again from prior to 2000 into 2000, and then in 2021, we can see that the 95 to 100% coverage results in a premium subsidy of 25%. So you're paying 75 cents on the dollar for coverage compared to earlier times. What does that look like in terms of the implication for, we'll take a look here at what's the implication for October calves. So here is the coverage that was available yesterday for steer calves for October, mid-October delivery or mid-October sale date. So there was coverage available at about 100% down to 87% of the end price. The end price right now uses the October futures price from the CME. So that price has been around 140. They tack on a 10% price adjustment factor for calves, steer calves. That takes you up to about $155. So that's the end price. Off that end price, you deduct the coverage level, and then you deduct the premium that gets you down here to this floor price. So as of yesterday, the highest coverage you could get would be $147 after paying the premium. And as the coverage levels go down, the premium outlay goes down. That's why the subsidy being high at the low levels of coverage really doesn't matter, because the premium cost goes way down as well. It's analogous to looking at a way out of the money option, put option. Those become very, very reasonably priced, but you're not getting a lot of coverage at those low levels. The other way to look at LRP is to see the prices available going out through time. So this is just the feeder cattle price without the price adjustment factor. This is probably more appropriate for somebody background in calves, looking at selling those calves, let's say in February or March of 2021. Here we've got the expected end values all around 140. Taking off the observed premiums gives you a floor price in that 138 area or 137 area, regardless of the end date at this time. That's very common to have a fairly flat set of choices when you're looking at the feeder cattle. What are some of the price projections right now? So earlier this week, the Economic Research Service put out their price projections for fed cattle and feeder cattle for the remainder of 2020 and the first half of 2021. You can see here they've got fed cattle in the low 100s, and feeders in a 133 this fall, fourth quarter 131. You get out in the first quarter next year 130. So the futures price right now and the price protection level right now would be higher than the ERS price projection for feeder cattle. So it would be a time to consider something like LRP to give you some upside price protection. Now, before I stop, I'd like Heather to put up the other question. So a second question here related to livestock risk protection. I am curious whether you think, for either yourself or your customers out there or other producers, do you think that the higher subsidy and or the change in the payment period might affect, probably positively, is that big enough to affect or result in an increase in demand for livestock risk protection? Will that subsidy matter? Will changing the payment from now to the future matter? And try to not be influenced by what others are saying, I guess including the presenter in this case. Waiting for that 10th person to jump on. Maybe. There we go, 10, 11. Heather, it's up to you. Should we stop the poll? There we go. So maybe that subsidy will have its desired effect of increasing the utilization, and perhaps coupled with changing the payment, it might increase. So thank you for participating in those two polls. That's interesting to see. So that's what I had relative to livestock risk protection and the related changes. If you do have questions, I'd happily answer a few now, or if there's any in the chat. If not, you can contact me. Primarily use that email address as a good way to get a hold of me. I've also got the business phone line there for another way to contact me. I'm going to stop sharing my screen. If there are questions, Heather, are there any questions?
I don't have any questions that came through from the chat area. So if you have anything, I'm watching the unmuting of the buttons, and it doesn't look like anybody's going to take that up either today.
That's fine. And if you do have some questions and want to visit about it, please get a hold of me. I'd happily visit about it, and especially as it pertains to maybe how LRP fits in with other ideas and ways to look at prices. But it's an interesting product, and it's a good. These are positive changes from a producer's perspective for the product itself. So thank you.
Okay, thank you, Matt. With that, we will turn it over to Jack. And Jack, if you wanted to start sharing your screen, we'll go from there. Looks good.
Okay, we'll get started. I'm Jack Davis, the Crops Business Management Field Specialist out of a Mitchell office, and of course working through home yet through the COVID deal. So we're going to do a little bit on land values and rents, and we'll get going here. And why do I not move, Heather? There it goes. It's just slow. So a couple of things, sources, the new publication for 20 is out, and here is the link to it and just the title there. Also, if you're a property owner or renting property, here is a good source to gain more knowledge of the specific piece of ground that you own or are renting, is the web soil survey, and you just start that and can highlight your area of interest or field and learn the soil characteristics of that property that you're interested in. And also a good source for soil owners is this book. It's a pretty basic book, but helps you learn about soil properties and soil health. And also good as a tenant or landowner to know the soil nutrient levels for the specific tracts that you're using. And we all know we have those areas in South Dakota that have been farmed and probably just aren't doing very well productivity wise. And there is a program out there called Every Acre Counts. And if you're interested in that, here is their contact to get more information on the Every Acre Counts program. So we got the factors impacting land values, and we'll touch a little bit on each of these as we go through today. And you'd think with these tight margins that maybe we'd see maybe more of a decrease, or we're always getting the question, are we headed back for the crisis of the 1980s? And until interest rates would happen to take off, I don't feel that we are. And part of it is it's a thin market. There's a low supply of land for sale. So people are not forced into selling, having to move land to gain cash or get out of the business. The land is in still fairly strong financial hands. We'll see at the end of it, I have a little table showing the effect of cap rate, we'll call it, or an interest rate, and we'll see that. Land is still a good hedge against inflation. You know, it's been really resilient and it's stayed stable for quite a few years. So people outside see it as a good investment. And it does still have some investment potential for non-ag buyers. So the negatives are as for the operator. You know, we've been under margin squeeze here for the past 3 to 5 years, really, for some. last year in South Dakota, weather-wise, didn't help us either as a producer, and most recently with that kind of long stretch of low profits, we're putting pressure on our working capital. So this year, let me see if I can get my pointer, and I'm going to jump around here a little bit. Hang on. So you can see we rose up to kind of peak in that 13-14 time frame. This is a cropland values from our survey. This is the average from our SDSU survey, long running survey since 1991. And we peaked in that time frame of 13-14, and have kind of just slowly declined, a little bit stable. And we show in ours this year about a 3% decline on average cropland. Whether that happened in your specific area or specific piece of property, I'd like to know. You know, does this fit what you guys are seeing, or is it off from what other people are seeing? I've talked to some, and they saw some decrease, but you know, good properties or strong properties that are easy to farm, good soils, they're holding fairly steady. Again, going back to some of those positive factors that I listed. And the green is pasture. So pasture, you know, we had our cattle prices were real strong, our livestock prices real strong in 14 and kind of into the beginning of 15. So that was a little bit behind probably in cropland peak, and we have seen that taper off just a little bit this year. So just wanted to show a little bit on the change in stock market and commodity prices. The S&P took from our COVID or virus shutdown practices, you know, it took a pretty good hit right as that started into March, but it has fairly well rebounded. This is West Texas cash price for oil, and it dropped close to 70%, but it's picked up about half of that coming back. So a little more travel going on, a little more demand for fuel and oil again. We'll do that with corn and soybeans. Corn took the biggest hit. Well, it was impacted most by the reduction in ethanol use, and then also stress on feeding. So two of its main sources for corn surely made it take a hit. And then now we're probably more into weather and carry out and outlooks of that nature. But corn off about 16% from the beginning of the year, and soybeans down about 6 to 7. There's a volatility index, also sometimes called a fear index for the S&P. And if this is above 30, it's just showing that there's a lot more volatility out there, and below 20 is stable. So I guess if we take a look back here in 19, how stable it was, running below 20 the full time. And as we move out into the time that our coronavirus came to the US, you know, it took off and went really high. Came back down, it's still above that 30 level. So people are feeling that there's a lot of risk out there and maybe looking for more stable investment. On the other side, taking a look at operator and land returns. So kind of a busy slide, but the bars are the return to labor and management and land, and for the different crops. So alfalfa in the green, and corn yellow, soybeans red, winter wheat blue, and spring wheat the brownish. And then with our land rents going across. So most of them pretty good as we come through 2013, but then just corn and soybeans, you know, we're below what land rents were. So tight on margins for the last anywhere from 3 to 5 years. On that same hand, there are farms, and this is taken from University of Minnesota, a FinBin, so it's people that belong to a record-keeping association, and I used farms from North Dakota, South Dakota, Minnesota, and Nebraska. In that pool, as a total, there's about 2,500 farms that are, provide records to that and are housed at U of M. And what I've done is just break that down by different level of gross income. So here at the very left is 100,000 gross income. Here's 100 to 250, 250 to 500, 500 to 1,000, and then on up. And then also broke it by a high income level being the green, and all farms in the middle with the blue, and the lower income or bottom 20%. I think really that's what I wanted to show is the bend in the curve, if we'll call it that, when we get to this 250 to 500,000. And the lower end on there tends to go down harder, and the upper end is still going up, and also if it's enough weight to pull the all farms up. So I just thought that interesting that there was that break in that line. Switching it up a little bit, using that same pool of farmers, but narrowed it down to 1,000 to 2,000 acres of cropland. They could also have livestock in this. I didn't sort it just for crop farms, so it does include livestock farmers, but they have to be farming at 1,000 to 2,000 acres. So that's the pool I used, the same states, and then went one tier off of the bottom and one tier off the top, and just showing their working capital per acre. So started out, fairly close together. Both kind of hit that peak in the mid 400s, a little different time period, but that's where they peaked. And the lower side, they really fell hard and were not able to recover that working capital per acre, where our upper end has recovered it a little bit and staying in that a little below 400, say 370 or so per acre of working capital. Bringing it a little closer, these are 2020 crop budgets. I didn't adjust it for lower prices. I maybe should have. I guess I thought it looked tough enough, maybe the way it was, and that we had some stuff priced. But so this would be in East and Central. Would be about shooting for 180 to 200 bushel yield. And here's direct costs: fertilizer, seed, chemicals, harvest, all those things that go into it. Equipment cost held fairly steady for the different crops, and then its return that would be able to pay for land. So I've taken a labor charge of about $40 out per acre. So there is some return there. It also would be really kind of some return to equipment, but and those costs vary by individual producer quite a bit. So not really making that return in these crop budgets that's needed to support a higher rent level. So some stuff from the survey itself. This is gross rent to value. So what we take is what individuals that responded to the survey, what they have said is the rent, and then also comparing that to value. So we're not taking anything out for property tax in this. So it's a gross rent, no reduction in property tax. But that really tracks interest rates. I did not lay interest rates over in this graph, but if you would go back and think of interest rates in those early 90s to mid 90s, and then we have just come down, and this cap rate, if we'll call it that, has really just followed that quite well. And some would say that that's even lower as we've come into spring and interest rates fell, that's probably even a little bit lower than that, than when this survey was taken. So this one is going to show rent coming across the top here. So we'll start at our 0 point, if we will, our middle. So at $200 and $62.50 for land value, and with a 3.2% interest rate. I think what I want you to pick up out of this, we could see in this time of low interest rates, trying to get the economy going and maybe pushing those rates low for a long time, we could actually see rents going down and an increase in value. If our cap rate, our acceptable cap rate or return would go low enough, the value of the property could actually go up, which is kind of counterintuitive, but I wanted to highlight that, that we keep thinking as producers that that land value should decrease some, and interest rates will have the biggest influence. And this just kind of highlights that we could actually see property values hold really steady given the low returns that are out there in other areas, and the perceived risk, where farmland is still been real resilient, and right now does not appear to be a risky investment. It seems to be a safe investment, and people are looking for that. So again, the thin market, now it has picked up some this past winter, was more offered for sale probably than the year before, but still not a large supply hitting the market. Low interest rates, probably the biggest factor, and those other two also being positive. And of course, then our negative is the low return. And as the longer we have those low returns and tight margins, the more stress that working capital can be, and that can be negative from a farming standpoint, and a wanting to pay rent, higher rents. So there's that, putting the downward pressure on it. But for the most part, we saw about a 3% decrease in cropland, and a little more than that, a little over 3 on pasture land. So we'll open it up for questions. There's our source again, and you can look through that. Now, there'll be some articles coming out, and if you sure have questions, you can get a hold of me, get to my contact information. Again, email, phone, we get messages through the phone too. It comes to us. So either way is fine to contact me, and that's what I have for today. I went through that kind of fast, but what do we got, Heather? Anything?
Everyone's pretty quiet this morning.
Yeah.
Guess we needed more polling questions.
I should have polled. And we can just do an informal poll.
There you go. Type in.
Yeah.
I do not have any questions at this moment. If anyone has something that they would like to ask here quick. Otherwise, we'll go into the final presentation and just talk a little bit about leases quick for 2020 and creating them. And maybe that'll generate some questions as we get through to the end.
Okay, so I'll stop share here.
So to wrap up here today, I'm just going to kind of talk quick about creating your land leases for 2020. Talk about the different types, components, maybe some quick pros and cons of the differences. give you some ideas where to look for rates and then some other resources. In South Dakota, we do allow oral leases. They have a maximum of 1 year time frame for those leases as they go through, and written leases can be for multiple years and long term. It really depends on you how long those would be. A lot of the producers I talk to are not very comfortable with long-term leases on crop ground, so many of those renew annually as well. Components that every lease needs to have are listed there in those bullets. We need to know who's involved in the description of the land, some general terms that should be in every lease as we go through, what the termination date and how that needs to be initiated, operation and maintenance, landowner rights and government payment components, and arbitration of any differences. Underneath each of those main headlines is a lot of additional bullets that you could include in your lease or should be talking about amongst the different people involved in the leases. I'm not going to talk about pros and cons of each one of them, but you can see there's a lot of things involved. And when we don't talk about these components, that's where the issues and the frustrations might come into play, especially if we have an oral lease where we're sure we talked about one of these things, but nobody really remembers the complete components, or we have very differing memories on what the situation was going to be. So making sure that we're addressing all of these and we have a written document of the answers and how we're going to proceed is very important. So if we talk oral leases versus written leases quick, you know, that oral lease is pretty easy to develop. We use a handshake and we're happy with what goes on. You know, we've talked about the rate and which piece of ground it is. The downsides, you know, memories change. Other people don't know what the leases are. So if we become unable to fulfill our daily roles that we traditionally have on our operation, that might come into play and cause some problems down the line. Written leases, you know, they contain all of the covered parameters that we just looked at in that big list of information, and they provide that memory. We can go back and say, okay, who was supposed to be responsible for taking care of fences? Or who's in charge of the weed control? Did we discuss government payments? And is the landowner going to get those payments, or does that go to the renter? And have those discussions right away and up front, and we know how we're going to deal with them. They do take a little longer to figure out and fill out. We have to have those conversations and get everybody's signatures on them. But once we do that, we make copies. Everybody knows where we stand for the lease for that year. We also need to talk about determining the right farm rental rate. There's a couple different ways, and those four are listed there. What the going market is for rental rates in your area, the amount the farm business can afford to pay. You know, that always comes into play a little bit there as well. What about the owner's farm ownership costs? What type of return do we need as the land owner, taking into account the depreciation, insurance, any repairs or maintenance to that ground, taxes, and then maybe there's that interest and opportunity cost if we did something else with our money. And the last one there that says other costs or benefits that the farmer or landowner might add to the arrangement really play into the average rental rate that we're receiving or paying. Some of those types of things and the conversations when they come into the office include snow removal. I don't have to do any snow removal at my house because my renter takes care of that all winter long. And depending on the winter, that might be a very large financial contribution. So the rental rate reflects that a little bit as we move forward in a less cash payment due. So those types of things need to be thought about and considered as well. Especially a lot of times the absentee landowner is the person negotiating the leases might be the children of mom who's still living on the property, and the land renter really takes care of mom because the children aren't around and available so they get a better deal on their land rental rate due to those extra circumstances and assistances provided by the land renter. Some of the resources that we put available to you from SDSU Extension, we have the crop and livestock budgets. Knowing what your direct costs are going to be can help you determine what a fair rental rate or an equitable rental rate might be for you. The land market trends publication that Jack just talked about is also on that extension webpage and available for you as well. When it comes to creating those leases and utilizing a template to help you get started so that you know what they need to look like, we really utilize the aglease101.com a lot. This is a collaboration of the North Central Farm Management Ag Extension Collaboration. I don't think I have my whole acronym correct there. But it's been looked at by the North Central region, economists across the region. It's been vetted by some attorneys, so you can use these templates and put your numbers in, put your information in, cross off the areas that don't apply. Maybe you have hunting rights that you want to add into that as a component. You know, those types of things are available for you to take advantage of at that web page there. The website has different documents that provide you with a full opportunity to read pros and cons, read up on the different components that are included in each item or in each of the variations of leases. And then it has a different tab for the templates. It's got leases there and has the conversation about crop rental rates, either cash or the variable leases that were popular when prices were high, so that the landowner could take advantage of prices going up as well. There's pasture leases. It talks about renting and leasing of livestock and also buildings. So it really covers a wide variety of the types of things you guys are out there renting out and utilizing on your farm operations. Another resource available from the Iowa State University Extension is this rental rate estimation calculator. And that can help you not only put in your production costs, it gives you some different components as you go down through the bottom on equitable treatment of the landowner and the renter, so that you can create that fair lease agreement between the two of you as you move forward. So it gives you lots of great tools as you move forward through that part. So with that, here's my contact information. If you have questions about leases, or if you need to renew your lease and want that template, you know, we can sure help you find that as we move forward. Additionally, if I stop my screen share here, you know, Matt, Jack, or any of us are available to answer any of your questions related to the topics that you heard about today, or any of the other topics from the past sessions that we've had. We would sure entertain any of those at this point. And also take any questions or ideas for, you know, the August meeting coming up. So with that, anything from anybody? Jack or Matt, anything you forgot to add into your presentation you want to discuss with them at this point? I guess I do want to hit one real quick thing. September 1 is the automatic renewal date for your oral lease. If you have an oral lease in place, you need to notify your renter or landowner if you are planning on making some type of change in writing by September 1. So make sure you keep that in mind.
Yeah, the key there being that it has to be in writing too. According to, you know, if there's a dispute, or if you're going to make that notice on either side.
Right. Well, I don't see much action in the chat box, and nobody has unmuted their microphones. So with that, we will tell you thank you very much for joining us. We plan on doing it again in August. If you have feedback from this meeting and you'd like to share that with us, please let us know. And we will plan on doing it in August. And as soon as this gets all all the features tweaked and the captioning put to it, we will get it emailed out to you. So with that, thank you everyone. Have a great day, great rest of the month. Be safe. Stay hydrated during this next heat spell that's coming through.